You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have easyJet, LVMH, Rentokil, ASOS, Dunelm, and our US company of the week is Netflix. Sam, shall I kick us off? Oh no, do you want to kick us off with easyJet?
Yes, I will. So easyJet have come out with a Q2 trading statement, and revenue per seat rose 8% in the second quarter, which was better than expected. This reflected strong demand and helped losses over the winter period fall by about 50 million. The headline loss before tax is expected to be 340 to 360 million for the full year. The group saw a 40 million direct impact from disruption in the Middle East, and flights to Israel have been suspended for the summer. Overall capacity is expected to increase 8% in the second half. easyJet continues to see strong demand for its holiday business, and overall summer bookings are building well. The shares rose 4.9% in early trading, and separate to this statement, they do have plans to buy almost 160 aircraft in the coming decade as they try and future-proof the business. In terms of the valuation, the business trades at a price to book of 1.13, and that compares to a 10-year average of 1.72. Prospective yield is 2.8%, and that compares to a 10-year average of 3.2%. I mean, there's not much meat on the bones of this trading statement. I think it's good that they're doing better than expected. We've commented before, it's, impressive how quickly things have kind of gotten back to pre-pandemic levels, but they are still losing money. They took on a lot of debt in the pandemic, and even if they hadn't, it's just not a very attractive business. So I think it's interesting to get a feel for where the overall economy is doing, but I would never ever touch it in a million years. What about you, John?
Yeah, similarly. And yeah, 340 million loss before tax is quite sizable.
But better than expected.
But better than expected, yeah.
Which I think tells you
Still
a lot about
quite
the
sizable
business.
is probably what I should say.
Right, should we move on to a higher quality business?
Yeah, so probably one of the highest quality businesses, LVMH. So it's owner of Louis Vuitton, Christian Dior, and many others. It's got probably the best stable of brands in existence. It had its Q1 trading statement out. LVMH's organic revenue rose by 3% to 20.7 billion euros in the first quarter. This was slower than the 10% achieved in the previous quarter. Wines and spirits saw a 12% decline as champagne sales fell, with demand normalizing after the pandemic. There's also been a cautious behavior from Hennessy customers and a decline in watches and jewelry. All other divisions saw growth, with the group's biggest division, the fashion and leather goods, recording revenue growth of just 2%, reflecting weaker growth in Asia. The group referenced the uncertain geopolitical and economic environment, but said it remained confident at this early stage of the new financial year. And shares were up nearly 2.5% following the statement. In terms of valuation, LVMH has a market cap of just under 400 billion euros, and it trades at 23.7 times forward earnings, with a 10-year average of 23.3 and a prospective yield of just under 2%. I thought these results were a bit disappointing, especially when you're looking at the valuation that it has. That being said, it's probably the most high quality portfolio in fashion, and it's difficult with the macro situation in China. And I suppose globally, despite this being at the higher end and theoretically less susceptible to cost of living crisis, the global economy does inevitably impact on it. It is still cyclical. I suppose what you would say is, since we've been covering it over the last few years, this is as cheap as we've seen it, or at least towards the cheaper end. So is it a reasonable time to get in when there is more negativity surrounding it, given that this is the sort of stock you could hold in your portfolio, sleep well at night, and hopefully compound over 2 decades? That is the case for it. And looking beyond kind of this Q1 trading statement. Sam, what are your thoughts on that?
Really similar. I think, I agree, this is the most disappointing statement I've seen. I think it's expensive at 24 times forward earnings. I think you struggle to justify that valuation when it was growing 10% a year. I think at 3%, I just think it's a really, really high quality business. I know why people would love to have it in the portfolio. Like you say, some of the best brands in the world. I think if you wait long enough, you will be able to get it cheaper, or at least get it, when the earnings are a bit higher and it's maybe grown into the valuation a bit more. But, I don't think it's never going to trade below 23 times earnings again. So you're saying these results are disappointing. Shares were up on the announcement. Find a bit bizarre. So I just, I think I agree it's disappointing, but I just think if it was on my watch list, I'd probably carry on waiting and hope that in 6 to 12 months it's maybe a more reasonable valuation. Because for a business that's growing 3% a year, why would you pay 23 times earnings? Even if you thought it could get back to 10%, that's still very expensive. So I just think great business, but just the valuation is not right for me.
Yeah, no, fair enough. And I suppose, as you'd always say, the group can't, change the valuation. That's just what the market thinks it's worth.
No, it can't. And it is a reflection of the quality of the business that people are willing to pay up for it. But I wouldn't want to be one of those people.
Yeah, fine. On to Rentokil.
Yes, so business we've not done for a while. I think we last covered it a couple of years ago. So Rentokil have come out with a Q1 trading update, and group revenue is up 4.9%, of which 3.1% was organic revenue growth, and they've highlighted continued pricing momentum. North America growth performance has stabilized with organic revenue up 1.5%. Early initiatives of Right Way 2 growth plan are underway. Organic revenue in pest control overall is up 1.5%, and pest control services for commercial, residential, and termite customers are up 1%. Customer retention was stable at 79.5%, and their pricing activities were successful in passing cost inflation to their customers. North America colleague retention increased further to 76.7%, and that's up from 75.2% back in December, with the largest improvement in sales colleague roles up 2.7% to 69.1%. We launched a new compensation plan for our Terminix sales colleagues to support the continued improvements in sales colleague retention. There was good momentum in organic revenue growth, and that was sustained in all regions. So it was up 6.2% in Europe, including Latin America, which is the group's second largest region, up 4.1% in the UK and Sub-Saharan Africa. These are grouped quite strangely, and up 3.2% in Asia and 7.3% in the Pacific. I'm not sure why Europe's grouped with Latin America and why the UK is grouped with Sub-Saharan Africa rather than Europe, but that's for management to know. Organic revenue growth across all categories. Pest control was up 2.7%, hygiene and well-being was up 3.8%, and France workwear was up 7.7%. The group's bolt-on M&A program continued to create value with 8 deals, delivering annualized revenues in the year before acquisitions of 45 million. This includes the acquisition of High Care Services Private Limited, the second largest pest control company in India. We remain confident in our targeted spend of about 250 million in 2024. The group is on track to deliver on expectations for 2024, including 2.4% organic revenue growth in North America, accompanied by modest margin progression, which we continue to expect to be weighted towards H2. So for reference, for the revenues of the total revenue of about 1.3 billion, 761 million is North America, 264 is Europe and Latin America, 103 is UK and Sub-Saharan Africa, 86 is Asia and looks like Middle East, and 67 is Pacific. In terms of the valuation, the business trades at a PE of 18 and has a yield of 2%. Just have a look at the financials for the last 5 years. Yeah, so revenue's grown quite a lot, but I think that's mainly been funded by acquisitions by the sound of it. So they've acquired recently Terminix, so I think that's why revenue's jumped to, well, it shows in that, isn't it, actually, because only 3.1% of the revenue growth is organic last quarter. Adjusted earnings per share are up a decent amount over that time. But yeah, I think at 18 times earnings, 2% dividend yield. I think these results may be slightly disappointing for 18 times earnings. And I just don't, it's already quite a global business. I know it's still mainly US, so I guess there is room to grow in the rest of the world, and they do have quite a good foothold to do that. But I'm not a huge fan of companies that buy the growth, which seems to be what they're doing. So yeah, I just think at 18 times earnings, I probably wouldn't be that interested. What about you, John?
Yeah, I think probably similarly. And yeah, I suppose how the growth is being acquired, and probably as well some of the results that we've got used to. It's moderated a lot, so it wouldn't be one for me.
All right, should we move on to another business that probably isn't one for you?
Well, yeah, and it's sort of, well, the stock that we do own, which is Boohoo, is kind of very closely related and correlated to ASOS, which was the bigger of the two online fast fashion giant. They had their half-year results out, with ASOS's first half underlying revenue falling 18% on a like-for-like basis and ignoring the effect of exchange rates. This comes as discounts were used to help clear their excess stock. Underlying loss before tax grew to 32.6% to £120 million, driven by lower sales levels and the impact of profit initiatives. The group is ahead on plans to improve stock efficiency and reduce inventory by a further 20% this year, back to pre-COVID levels of around £600 million by the year end. Free cash outflows narrowed from 259 million to 21 million pounds. Clearing excess inventory helped free up cash. A net debt stood at 652 million pounds, down 16.2% on last year. And there was no change on full year guidance, including a 5 to 15% sales decline and return to growth in the final quarter. The shares were up around 7% in early trading. In terms of valuation, ASOS has a market cap of £427 million and trades at 0.1 times forward priced sales, compared with a 10-year average of 1.3. And as you'd expect, it doesn't pay a dividend. I thought these results were very disappointing. I appreciate the markets. Perhaps they weren't as disappointing as they were expecting, and the fact that they kept the return to growth in the final quarter is still in there and said that they're on track for that. But I think that is a big if. I mean, fantastic if they're able to deliver it, but it's got a lot of debt. And as we saw in the last few years, they've burnt through an awful lot of cash. They've done an equity raise. I think that they're in serious trouble. And the same with Boohoo. Yeah, it is very, very uncertain. I think there's a huge amount of competition in the end of the market that they operate at, and in a lot of distress at the moment. I do note that Mike Ashley is increasing the share in both ASOS and Boohoo. Perhaps he sees something more to it, but yeah, it's a very distressed company. Sam, I know the answer to whether you'd be buying more, well, shares in ASOS, but what do you think? Do you see any glimmers of a hope here?
Not really. I think the results are really bad. I do find it so surprising how quickly things have turned around for ASOS if we compare to how it, was booming away as we went into the pandemic, and then here we are 2 or 3 years later. And like you say, it looks like it's in quite serious trouble. I'm stunned by how quickly it's gotten into that position. I never would have predicted the drop off, because I wouldn't have bought Boohoo 2 years ago if I had. But yeah, I just can't. I struggle to believe just how quickly it's gone so badly for both ASOS and Boohoo, because I just didn't. It seemed, if anything, like the market was, going to carry on heading in the other direction. I am gobsmacked by the size of the debt, how quickly it's built up, how big the losses are. I mean, what I find amazing as well, underlying loss before tax grew 32.6% to 120 million, driven by the impact of profit initiatives.
Well,
whoever's responsible for that someone needs to have a serious word with them. But yeah, I think it's really difficult as well, because we'll need to have a look at Boohoo's results when they come out, and hopefully they won't be as bad. But it reminds me of looking at Ted Baker a year or two ago. It really does. And I just think, do you just take the loss and get out with something? Now, Boohoo might not be as bad as this. We would need to look, but I mean, it's not. I'll see when Boohoo. Do you know when Boohoo reports?
Let's have a look.
Just have a look at investor relations, but not anything since October 23. So they must be due something.
There must be. It's got nothing penciled.
I don't think they'll want to do any trading statements, because they're not going to have much positive to discuss.
Yeah.
Because it must be out. It's about, we're getting on for 6 months. So it must be something very soon. But
and I think at one point, Sam, you did have shares in Debenhams, and I remember did you buy it for £1 or something, and then sold it for 20p? But it was a stock that actually Sorry, 50p.
I thought it was quite cheap at £1.
Yeah,
Wrong.
and you said that was one of the best trades you'd made.
Yeah, it was, because it went down to 0. So
Yeah.
I think Boohoo
So
could be shaping up to be just as good, actually.
just as good.
But we'll see. But Boohoo,
And
in fairness, isn't as down as badly as ASOS. So Boohoo's only down 90% in the last 3 years, whereas ASOS is down like 94, 95%, which, might only sound like 5%, but that means you've got 50% more if you kept your money in Boohoo rather than ASOS. So
yeah,
it's been worse. We could
and
have bought ASOS.
it started out with, I think, more cash, didn't it? It had more generous cash reserves at Boohoo, which I'm sure we'll find out how much of those are left. Probably will probably be negative, but anyway.
Yeah, I think it might be getting to time to sell it, to be honest. Because
Yeah,
if Boohoo releases something that looks like this, I think I'm out. Because
you're
you look at
out.
that
Yeah,
and you think, they could be going bust in a couple of years. I think really it's like when Mike Ashley starts buying shares, that is the vultures circling.
it's a very bad sign. It's a
If
very
you're in
bad
with
sign.
Mike Ashley, you've got a big problem.
Yeah, and usually you're in before he's in. So because if he's
You're in a
going in,
lot
you're
before.
getting out. So
Yeah, so
anyway,
right.
it's
Should we move on to
too
a
late.
better retailer?
Yeah. Okay. So one that we have liked traditionally on the show, Dunelm.
Yes, so Dunelm have come out. It's a lot of trading statements this week, I'm afraid, but Dunelm have come out with a Q3 trading statement, and total sales were up 3% for the quarter and 4% for the year to date. And the digital percentage of total sales for the year to date was 36% and 37% for the quarter. So that is continuing to increase. It's not quite at next levels of digital sales, but it is getting there. And I think for Dunelm, I'm actually quite surprised the digital sales is as high as it is, because you would think with homeware, a lot of people do want to go in and have a look at it. So I think that's actually a very, very impressive number, and it's still growing. So they've said the sales growth was driven by volume. They've had growth in both store and digital channels, and full year gross margin is now expected to expand by 110 basis points year on year, so 1.1%. They've continued to strengthen their customer offer as the home of homes, and despite a challenging sales environment, they currently expect 2024 profit before tax to be broadly in line with expectations. They've said, in relation to the gross margin, as expected, the rate of year-on-year improvement is slowing as they begin to lap the benefit of lower freight costs, while foreign exchange movements remain a headwind. They're managing the ongoing impact of Red Sea surcharges, and despite this, they now expect full-year gross margin to be ahead of previous guidance. So they expect the television campaign that's coming up to be viewed over 200 million times, with further exposure across radio, social, and other digital channels. They remain on track to hit their store openings target for 2024, with 4 new stores open to date and a further 2, including 1 relocation, planned to open by the end of the year. In terms of the valuation, business trades at a P of 13 and has a dividend yield of 4.33%. I think this trading statement sounds very positive. I think the digital sales is particularly impressive. I think that if they can continue increasing that, they could actually get to next levels digital sales. I think they're doing a really, really good job. I think, and the digital sales are going up, but that's not whilst the store sales are going down. They're both going up, and the digital sales are just going up by more, which is obviously what you want to see. We've been following this for a few years now, and it's pretty consistent business in terms of the kind of results it's been putting up. And at 13 times earnings and a yield of over 4%, I don't think it's that expensive either. So I really like this business. I think it's one of the highest quality retailers that you can buy in the UK. I think Next, for me, is possibly the only business that is ahead of it. But yeah, really, really good trading statement. Continued the trend that we've been seeing. And despite that, it's not very expensive. John, what are your thoughts?
Yeah, no, I thought it was really good. And I think it's also worth saying, the context with sort of the macro and macro pressures, and that we're in a cost of living crisis, that at the end of the market that it's dealing with, unlike LVMH, to then get 3% on the quarter and then have its digital sales, well, as a proportion increasing, but also growing in themselves, I think is very positive, very, very positive, and it is a quality business. Would I buy shares? I don't know. It's one I like. I think it would be sort of shortlisted, but I don't think it's probably quite good enough. And Appreciate it's a little bit cheaper than Next, but if you were to put them side by side, I probably would go with Next because I think it's just that bit better, but there's no knocking these results. And I think also comparing it with another retailer that's not totally dissimilar, but like Kingfisher, I would be choosing Dunelm. I think that's would be my pick over those two, but I think probably not quite at Next levels.
Yeah, I would agree with that. I think the main thing that would stop me buying Dunelm is the fact that I would always want to buy Next first, based on what we've seen in the last few years, especially given that Next itself isn't that expensive either. But yeah, I think you could do a lot worse than Dunelm. I think it's a very good business. I do wonder if maybe it's cheap because there's possibly some cyclicality with it, but
yeah. But I mean, you might say where we are in the cycle at the moment, particularly with where interest rates are, house prices, everything else, that if it's able to do this, and I appreciate things could be more difficult, but if it's able to do this in slightly more testing times, that does say a lot for it.
I think it does, especially when I know it's not a direct comparison, but if you compare it to what we've been seeing from the house builders, where they have, completely reasonably and expectedly fallen off a cliff, that hasn't happened with Dunelm. And I think that, again, is testament to the quality of the business and the offering that they've got. But
no, absolutely. So yeah, very, very good. Okay, on to our final company of the week, which is Netflix, the streaming giant. So have covered them a few times on the show. They had their Q1 results out last week, and they added 9.3 million subscribers in the first quarter, which was much better than expectations and compares to 1.8 million additions in the same quarter last year. Membership for the smaller ad-supported tier rose by 65% quarter on quarter, and overall revenue was up 18% to $9.4 billion, ignoring the effect of exchange rates, which was also better than expected. Operating profit was 54% higher at $2.6 billion, thanks to higher revenue and the timing of content spending. The group spent $3.7 billion on content in the quarter, and free cash flow was $2.1 billion in the period too. Including money owed for content, Netflix has net debt of $11.4 billion. Full year revenue is expected to grow between 13 and 15%. Underlying operating margin guidance has been upgraded slightly from 24 to 25%. And looking ahead, Netflix has said that it will no longer report quarterly membership figures. In terms of valuation, Netflix has a market cap of $240 billion and trades at 32.7 times forward earnings, compared with a 10-year average of 96, and it doesn't pay a dividend. I thought these were really good results, and they've had reduced churn and continued to have very good original content, which ultimately does underpin this. I think it's had a very difficult last couple of years, and they have been restructuring it and had a new strategy, which now is beginning to take shape. I suppose with all of these things, it's very difficult to justify the 32.7 times forward earnings, and it's hugely competitive in the market, and they do have to pump in huge amounts. I think it's about $17 billion yearly into producing that original content. But like I said earlier, encouraging to see that the churn is reduced, and it's I still think it's a good business, but I wouldn't be brave enough to pay up 32 times forward earnings for it, for sure. One that I'll definitely have a bit of exposure to in a world tracker, but as standalone, it's difficult. And I think you do see that now as well, because with its 10-year average, it was so highly priced, and then it had a difficult time after 2020, and you're now beginning to see it turn around. But I think that historic valuation, I can't see it getting back there anytime soon, because the sort of numbers it'd have to consistently put up, which arguably it was for a time, but I think we've seen the market mature, and you've got Disney Plus and streaming platforms from all sorts of different content creators, and I suppose historical networks as well. So yeah, not one for me, but very good results. Sam, what are your thoughts on Netflix?
Very similar. I think these are excellent results, especially as you mentioned, after the couple of years it's had. However, I think we are, although it's a huge add in subscribers, I think the last couple of years have probably shown it's probably not that sustainable. If it has a couple of quarters where the releases they don't have anything that goes viral or anything, I I think you will equally see just as large swings to the negative. I think, obviously, although they've added a lot of subscribers, they're probably not as valuable because they're doing ad-supported tiers. So I think, and that's up 65%. So I think that's partly where a lot of it's come from. And yes, it's fed through and operating profit's doing really well. But I think this is going to be quite cyclical in terms of when they've got content that everyone wants, you'll see these increases and then people might drop off afterwards. I don't think it's going to be consistently growing subscribers 10, 20 million a year for the next few years. And I think that's probably what it would need to be doing to justify a P of 32. I'm not thrilled that it said they're not going to be reporting quarterly membership figures. And I think that to me suggests that what I've just suggested might be the case going forward. They are also thinking, and they don't want that affecting the share price, because I don't see why else you wouldn't release that information to investors. And I think that's quite disappointing. The other interesting thing I thought was the net debt of 11.4 billion compared to the operating profit now. It's actually quite low. Probably less than 1.5x operating profit. And again, considering where that was a few years ago, I think they've done really well getting costs under control. A lot of the extra members are now just sort of feeding straight through into profits, which is quite good. They seem to have finally reached sort of economies of scale. So yeah, I think they're doing a good job. I just think the business, again, partly because of the market dynamics you've explained, I don't think the business is as attractive as it was 4 or 5 years ago. And I think because of that, I don't think I'd want to pay 32 times earnings for what I would consider to be going forward. Probably quite a cyclical business, but really, really good quarter. So I can't really knock it.
No, fair enough. Okay then, Sam. Of the companies this week, what would be your top pick and what would be last?
So I think top pick probably would be Dunelm. I think LVMH is probably the best company, but I just wouldn't want to pay that valuation for that level of growth. So I think it would be Dunelm, which is also a very good company anyway. But I think last is actually very easy this week. It would have to, well, actually, I don't know. Could be easyJet. But I think based on the figures we've seen, it would probably be ASOS because that looks like it could be going bust in 2 or 3 years. I think easyJet is bad, but not quite that bad. What about you, John?
Yeah, it's really tricky. I think I would go for LVMH. I appreciate it's very expensive and for the results it's putting up at the moment, but I think it's a stock that I could buy and just take a very, very long view on it. And that would be why, as opposed to Dunelm, which I think is very good and the valuation is fairer, but I wouldn't like to own it as much as LVMH, despite the valuation. I think that would be where I'd be at with it. But that being said, I'm not adding either to my portfolio at the moment. And then last on the list, yeah, I think it'd be ASOS. I don't like easyJet either, but I think it'd have to be ASOS with those results as well. Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.